Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from Aussie tax to the OECD's latest developments. I'm Doug McConey, PwC's International Tax Services Global Leader. PwC's Pillar 2 engine, powered by Beacon, is a game changer for Pillar 2 compliance, provision, and modeling calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is now available to license. On this week's episode of Cross-Border Tax Talks, we're in PwC's New York City studio, where I'm excited to have Sarah Hickey on the podcast. Sarah is a PwC Australia International Tax Partner, currently serving as the Australian Tax Desk Leader in New York City. Sarah, welcome to the podcast.
Thank you.
It's great to have you on.
It's lovely to be here.
All right. Well, welcome to the U.S. You relocated to New York City from Melbourne, Australia in January 2025 of this year. Before we dive in, there's plenty to talk about on Aussie tax, but what has been the biggest surprise about American culture since you've moved here?
This is a great question. I actually had to think quite hard about this one, and it's probably going to surprise you saying this when I've been living in New York City for the last 8 months, but I think Americans are very polite, and probably a lot more polite than Australians are. They swear less. We went to a baseball match the other day. Everybody was friendly. Everybody was really collaborative, and it was completely different to what I've experienced or what I expected of America. Like, I thought it was going to be a lot more kind of everybody go get 'em in New York, and that's really not been like that at all. It's been fantastic.
Well, I'm going to take the bait on the baseball match. Which baseball match?
This is where it gets interesting. It was Yankees-Red Sox, and everybody had warned us and said, this is going to be a crazy baseball game. Like, it's going to get aggressive. The fans are going to get really angry. And it was completely the opposite. It was delightful. I took my parents, and they were like, this is amazing.
Yeah,
so
angry baseball fans, even like are generally fairly civilized, although there are, exceptions to those rules.
Yeah.
I'm actually a little surprised at the answer. I've spent quite a bit of time in Australia over the years, and Australia to me feels like the Midwest. Like, you go to a coffee shop, a bar, a restaurant in Melbourne, Sydney, like, people will talk to you. Like, it's just like in the Midwest. You can go in, make friends with the person standing in line. I'll be honest, I've never lived in New York City, but I've never really quite had that experience. I tend not to maybe talk to strangers as much. Have you experienced that, or is it feels as friendly as Australia?
Oh, it's probably not quite a place where you talk to strangers, but I think over time you find your people and you find your place, and I'm sort of getting to that point now. And so I spend a lot of time in cafes, so lots of nice people around, and you just got to find them and avoid the not so nice ones.
All right. Well, I love New York and I love Australia as well, but I am a Midwest guy at heart. All right. So we're going to cover Australia tax. There was a big case that has come out recently that we're going to spend some time on. Before I dive in there, because there's a lot in that case, what I would like to do is really sort of set the table on, and there's been a lot of developments over the last few years in Australia, really kind of an overview of the Australian international tax system. And so before we get into some of the specifics, let's start with the why. Why are personal taxes and corporate taxes so important to the Aussie economy?
Yeah, it's a great place to start, actually, Doug. And so in Australia, our personal income taxes and corporate tax basically make up about 62% of the tax revenue collection for the country. So that's very high. I think the OECD average is about 36% for those two taxes. So very high collections from personal income tax and corporate income tax. On the counterpoint to that, our VAT GST rate is actually very low, and we have relatively low collections overall from that. So when we think about the levers that we have in our economy, what we're getting through the income tax system is actually very important. The other thing, obviously, with Australia is that we're a capital importer. We have a lot of multinational investment coming into the country. And to some extent, some of that investment is inelastic because we have resources and commodities in Australia that people are going to naturally come in and want to work with. But on the margins, it is a situation where sometimes we do need to do a little bit more to attract foreign investment than we're doing. The difficulty being that playing with our corporate tax rate has such a fundamental impact on our economy that it's not necessarily something where we can model ourselves on what others in the region do, like a Singapore or a Hong Kong. So you've kind of got this really funny situation where you've got a very small country that needs multinational investment that's competing against a 16.5% tax rate in Hong Kong, a 17% tax rate in Singapore, and fantastic incentives in those countries. And we don't necessarily have the same levers to attract investment and need to rely on other things to kind of make that happen.
Yeah, what's interesting, when you shared those statistics with me, I went onto the U.S. Treasury Department's website and some of the data that they have, at least for fiscal year 25. And interestingly, the U.S. and Australia are very similar. It's about 60% of personal and corporate income taxes. Now, it's almost 50% personal income taxes and 10% or 11% corporate income taxes. And then at least through the data that I saw, through July, that it was 3%, because I had to look this up, 3% comes from customs duty this year, and that's up from the prior year. So, but it is worth noting that I think the U.S. government's position on corporate income taxes, particularly now after the One Big Beautiful Bill Act, is certainly different than what we're seeing in Australia from a corporate tax perspective. So let's start with you already were hinting at the rates. Maybe just start with an overview of the Australia corporate income tax system. Maybe start with corporate income taxes and interest deductibility rules. Maybe a good place to start.
Happy to. So in Australia, the corporate rate is 30% for large corporates. There's a smaller tax rate for some small and medium businesses, and there's chat around whether to extend that a little bit further to encourage investment at that level. But fundamentally, it's a 30% rate, worldwide tax system, and I would call us an enthusiastic adopter of most OECD kind of initiatives. So
I would call you that too.
Yeah, thanks. So in terms of interest limitation rules, we actually just changed them last year. So we've got thin cap rules that are now modelled on a 30% of tax EBITDA rule, which has been rolled out, I think, at the beginning of last year. And with most things in Australia, we'll typically take what comes out of the OECD or what comes out of a BEPS initiative, we'll implement it, but we'll do a little triple somersault on the end. So there'll be something additional that's added in, either with the intention of making sure that we protect the corporate tax base or making sure that we fully implement what has been kind of advised at the OECD. And so with the thin cap amendments that have come in, what they have introduced in addition to the 30% of tax EBITDA test is actually an additional integrity rule for debt deduction. So where a related party has borrowed from, where one Australian entity has borrowed from a related party, and the purpose of that borrowing was for particular things, which we call bad purposes, which could include the acquisition of an asset from a related party, the interest deductions arising on that debt can actually be denied, even if that debt was entered into many years before now. So we're in a period of transition with our thin cap rules, but also additional layers of integrity are coming in as we kind of update and push forward with those rules.
Yeah, and on that interest rule, I just to highlight that point that even if a taxpayer did a transaction prior to these rules coming in, forces taxpayers to go back and look and understand what the purpose or what the actual borrowing was for, and it can impact those interest deductions going forward. One of the interesting things to note on the related party nature, if you're borrowing to purchase from a related party, that's a pretty common transaction, particularly in just a general integration. If one multinational acquires another multinational and you're looking to integrate the assets, very common to effectively acquire those assets. And if you are borrowing from a related party to fund that, that can be an issue under these rules.
Yeah, if the acquisition of the asset is from a related party as well.
Right.
So it's kind of in bespoke situations, but the challenge with it, exactly to your point, Doug, is going back and retracing and kind of unpicking your steps from many, many years ago. And we all know that related party debt is not necessarily at the top of someone's priority list to go and check every year if it's been in place for a long time. it's more likely that something just rolls over a period of time. And so one of the things that a lot of taxpayers have really been grappling with is kind of going back and retracing their steps over many years, and getting back to those things that I think lots of us had thought we'd left behind in terms of like sources and use of funds, and where have the funds today come from, and how did they exactly get there. So there's a lot of work to be done as we move forward with those rules.
All right, you had mentioned some of the incentives and some of the challenges. Are there any particular incentives before we dive into CFC and some of the other rules? Obviously, the U.S. now, we have our new 174, the R&E deductions. What's the state of play in Australia as you think about trying to compete for foreign direct investment, given all the other opportunities in Asia Pac, for example, for multinationals to look for investment?
It's a great question. I think it's a little bit of a patchwork, if I'm honest. So we've got a research and development tax concession, which is very popular. Australia is a pretty popular place to come to and do R&D in particular sectors. And the reason for that is it's a smaller market that has demographics that are quite similar to, say, the UK or the US. So it's a nice testing ground for things. And, there's obviously talented people there who can kind of get in there and do the research and development. So we do see quite a good, healthy use of the R&D concession. We've got an investment manager regime, which encourages foreign investment in through private equity and sort of private credit. So that's also a pretty popular regime. And then it gets a little bit random. So we used to have an offshore banking unit regime that would encourage foreign enterprises to locate a series of banking activities in Australia. So we developed quite large kind of outbound financial and fintech sectors through that over the years. That eventually got repealed. And then we've got a video games tax incentive that's actually pretty phenomenal. So it really does vary depending on sector, and it's probably not as organised as I would say it is in Singapore, for example, but that's really because in Australia, like I was saying earlier, we've got different priorities around what we're trying to do with corporate tax and how we're trying to incentivise people to come.
Got it. So maybe move on to how you cross-border tax, and maybe start with CFC rules. You mentioned it's a worldwide system, so maybe talk a little bit about that. Is it current tax, FTC system? How do you tax controlled foreign corporations, et cetera?
Yeah, so we've got kind of like a two-speed economy with the CFCs. So we have a small number of countries, including the US, that are what I would call good countries for CFC purposes. And those countries, typically we don't touch any income that is derived in a controlled foreign company from those countries. There are a few limited exceptions. One of them is, for example, in New Zealand, they don't have a capital gains tax, so we can tax a capital gain from a New Zealand CFC. But typically with those limited countries, we leave them alone. And examples, US, New Zealand, Canada, Japan, UK, very, very large trading partners of Australia.
So general exemption, even when you bring the cash back from those foreign subsidiaries?
So typically when the cash comes back, if it's a non-portfolio dividend, there's an exemption that can flow through for that. Yep. And there's examination of whether you've got an active or passive business that can be relevant there, but the rules differ a little bit depending on whether you're in those good countries or not.
So is there any credit, like foreign tax credit system, or does that apply maybe to withholding taxes?
Yeah, so we've got a foreign tax credit system as well, where you've actually paid tax on the distribution up, which is pretty rare in a CFC scenario.
Right.
But if you've got, say, a situation where you've got a minority investment or something like that, and there's a dividend withholding tax clip or something like that on the way up, there is a foreign tax credit system in Australia that can help you. It's a bit of a funny one though, because it's a use it or lose it system. So you have to use the credit in the year that you get it, which means that if you're in losses or you don't have enough income in that year, you actually don't get the full benefit of the credit. So it's a little bit of a savage concession.
So that's like our guilty system, right? With no FTC carry forwards. Obviously, you get the 10-year on the general basket. But yeah, there's others that don't give you the carry forward. All right, so maybe tell us a little bit about the withholding tax regime, and this is going to help inform, I think, also as we get into the Pepsi case. But generally, particularly royalties, interest, dividends, how does Australia deal with withholding taxes?
So dividends is probably the easiest. So we have this strange thing called a franking credit system in Australia, and typically what franking credits arise from is where you pay corporate income tax. So if you have an Australian company that has paid corporate income tax and it pays a dividend offshore, if it franks that dividend, you can reduce the dividend withholding tax to nil. So in a lot of scenarios with a tax-paying Australian entity, it can actually be pretty straightforward. Then we've got a pretty decent treaty network which will reduce dividend withholding tax, usually from its 30% domestic rate down to 15 or 5 or even 0 in the case of payments to a US listed company. So you can usually get to a pretty good outcome on dividend withholding tax. Interest withholding tax, Australia is one of the territories where we do have a 10% impost on interest withholding tax, and that applies to most cross-border interest payments. It's the domestic rate as well as the rate in most of our treaties. We do have an exemption for certain types of public offering of debt though. So on a kind of global financial markets scale, if there's what we call a public offering of a debt by a corporate entity, then provided that that's done in quite a prescriptive way, that can be done withholding tax free. And then there's also concessions in a few of the treaties for payments to financial institutions.
Yeah, similar to the US.
Yeah.
And then what about royalties, which is certainly the subject of the Pepsi case?
So royalties, the headline rate for royalties in Australia under the domestic law is 30. It drops down considerably under most treaties to about 10 or 5, and it's 5 under the US treaty. The language in our domestic law and in most of our treaties is not dissimilar, and we typically look at them in the same manner, and that's been the way that the tax office has certainly viewed it over a number of years. Relevantly in the treaty with the US, the way that royalty is defined is effectively a payment however described or computed. And that becomes a really interesting concept, which I'm sure we'll get into, and kind of invites, a broad examination of what's actually happening between parties.
Yeah, well, listeners are going to have to hang on because there's a few other topics I want to cover first. So we've covered withholding taxes. Australia has a diverted profits tax, as well as Pillar 2. Let's start with the diverted profits tax. We could dedicate probably an entire podcast to this topic, but can you give us just an overview of how the DPT works in Australia?
Sure. So the DPT we adopted after the UK. So the UK adopted their laws, I think, in 2015, and we took the 2 parts of their DPT and we called one part the MAL, which is the multinational anti-avoidance law, and then the second element we called the diverted profits tax. And fundamentally, what that tax is intended to do is attack a situation where there is a profit that might otherwise have been taxed in Australia at our 30% rate or under our withholding tax rules that has somehow been diverted or moved in a way where it's no longer taxable at that rate. The interesting thing about the DPT is that even though that's the intention, which is where the economic substance is mismatched with what's actually happening, we want to attack and correct it. The way that the DPT is implemented is that it's kind of slotted into our general anti-avoidance rules. So we have to look at a lot of concepts that come through under those rules when we interpret the DPT. So for us, there's a really important concept of a tax benefit. So what's actually happening under this transaction to give rise to a tax benefit? And can you demonstrate that there is an alternative situation where the taxpayer could have achieved the same commercial result without the tax benefit? That's really the way that both the DPT and our anti-avoidance laws work. But procedurally, the DPT sits outside of the anti-avoidance rules and it's actually imposed as a separate tax under separate legislation. It's imposed as sort of a penalty, so it's 40% of the diverted profit is imposed as taxation.
Big number.
Which is a big number. And the other thing that's interesting about the DPT is how it's administered. So the DPT, if an assessment is issued under the DPT, it effectively starts a 12-month review process between the taxpayer and the commissioner. And in that 12-month period, the commissioner and the taxpayer basically need to extract all evidence and all information that's going to be relevant to a dispute on that matter. So there are rules around admissibility of evidence that actually say if within that 12-month period, a piece of relevant evidence has not been adduced to the commissioner, it can't later be used in a dispute. So it's actually a really important 12-month window, and quite different to anything else in our tax system, where kind of like other systems, disputes can tend to drag on for years and years.
All right, so what about Pillar 2? So tell me about, you guys have all of these, just what enactment dates insofar as QDMTT, income inclusion rule, and undertax payment rule.
Yeah, so Pillar 2, we're in step with the rest of the kind of EU contingent, I would say.
There's some others in Asia Pac.
There are some others in Asia Pac. Yeah, it's sort of a patchwork. But for us, we've got obviously the income inclusion rule, the UTPR, and the QDMTT. Everything is sort of commencing as of the 1 July 2025 calendar year, but most lodgements are not going to be due until kind of mid to late next year. So there's still a little bit of time to run on that.
Okay. And was your income inclusion, did those rules come in 2024 or did they come in 2025?
2024.
2024.
Yeah.
And it'll be very interesting to see sort of what happens as a result of the G7 agreement. As a total aside, is it possible constitutionally in Australia for you all to be able to go back and change the Pillar 2 rules to effectively turn off the income inclusion rule, for example, to US MNCs?
I think it would be. I think it would be possible with legislative change. I'm not sure how we would do it without that. I think there'd have to be something mechanically that would go through the government.
That seems to be a common theme. And so I just wanted to bring this up. This isn't a Pillar 2 conversation, but it is fascinating as I've been talking to people around the globe. It's like this G7 agreement is very interesting, but practically speaking, there's 57 countries that currently have these rules. It was 36 that had them in 2024. How is all this going to get pushed through? But that's another podcast. So kind of along those lines, you have a DPT, you've got Pillar 2, Section 899, which we dedicated a whole lot of time on the podcast. What was the Australia kind of reaction, not asking you to speak on behalf of the government, but presumably, and as I saw, particularly talking to a number of Europeans, that you guys would have been right, Australia would have been right in the crosshairs of that.
Yeah, it was definitely an interesting time, and I think it was kind of like it got a little scary, and then it relaxed itself a little bit as we moved from the House to the Senate with the bill. But if we think about 899, there were really three problematic taxes when we started looking at that, which were the UTPR, which everybody had, a digital services tax, which we didn't have, and then a diverted profits tax, which was just us in the UK. And so we sort of had two of the three bad taxes. So we were very nervous about that to begin with. Australia is actually a 10% tariff country. So if you like, we're kind of in the good bundle at the moment on that. So we've had a good outcome. And so something like 899 could really dramatically change, where Australia came out in what was happening with OB3. The thing that was kind of interesting for us with the bill, and we were watching very closely as it moved from the House to the Senate, and particularly the language around how the egregious taxes were being described, is that notwithstanding that the DPT and the UTPR were under attack, that there are other things in the Australian tax law that sometimes can be seen as sort of pushing the grey in terms of how far they reach. And so we have imported hybrid mismatch rules that, like I was saying earlier, when we implemented, we took what the OECD had and we did a little triple somersault on the end. And so our imported hybrid mismatch rules have very far-reaching capability and can really pull back mismatches from the globe back into Australia and penalise them.
And those are just in your domestic legislation. That's
right.
What's very interesting is that it's your domestic legislation. We dedicated a few podcasts ago on the hybrid mismatch rules that are currently part of the safe harbor rules in Pillar 2, and obviously the OECD has said that they're going to bring those in. You guys have Australia has had to deal with those rules for a number of years and thinking about the application of when those rules apply, and there are a number of technical challenges with that.
That's exactly right. And the way that I describe it when we're talking to taxpayers about it is, it's kind of like with the imported hybrid mismatch rules for us, they're like a fishing rod. So somebody's they've cast their line out, and really any hybrid mismatch in the global group could be caught. And so because of the deeming rules, the grouping rules, and the way that the particulars of the legislation work for us, it's actually a really difficult process to try and get clarity on when those rules do and don't apply. And one of the things that we do end up discussing with taxpayers a lot of the time is this actually extraterritorial in how far it's asking me to reach outside of the Australian tax net? And so I suspect the answer is grey, like everything, but certainly as 899 was going through, that was something that we were just very quietly watching carefully and trying to reconcile what we were seeing in the Senate bill to how those rules worked.
I mean, everyone that I've spoken to outside the U.S. that had one of those taxes was obviously very, very concerned. We'll see how this develops, and potentially with the thought of a second or third reconciliation bill, and we'll see how the G7 agreement progresses. But I have a feeling we might not be done talking about 899, but we shall see. Before we move on to the case, there's a whole number of compliance requirements that I would posit are unique to Australia, or where Australia maybe has some more challenging. You guys have been on the front end. Obviously, you've got corporate income tax compliance, Pillar 2, but maybe start with your country-by-country compliance obligations, and that got a lot of attention when those originally came in, and maybe talk about those and where those stand.
Yeah, so we've got a couple of transparency measures at the moment that are quite topical and for good reason. So it's helpful to take a step back and kind of ask why. And so we've got two things. We've got public by country by country reporting, which has been legislated in. And then we've got some new rules called the short form restructure rules, which are administrative rules in our transfer pricing law that will significantly increase disclosure around global restructures. So with the public country by country reporting, it is going to require a level of disclosure that goes beyond what the EU expects of taxpayers. And that is intensive and for some taxpayers is quite concerning. The main reason for that public country by country disclosure requirement is quite interesting. So when you go and look at the legislation that introduced the bill, what they explain in there is that Australia feels like it has a responsibility on a global scale to make clear how multinationals are paying tax and to invite a conversation around that. So the purpose behind the intensity of our public country by country reporting is actually driven by Australia feeling, and this goes back to the BEPS or OECD enthusiast point, Australia feeling like they have a responsibility on a global stage to kind of make that conversation happen. And so how we see that manifest with the public country by country reporting is that the level of disclosure goes down to sort of isolating out where IP is located. In certain situations, you need to disclose which particular territories it's located in. There's going to be a lot of detail in that for many taxpayers is not something that they're particularly comfortable with sharing. And so the Tax Office has just released some draft guidance around exemptions, including exemptions for commercial secrecy and situations where it is not appropriate to disclose that information. So that's something that everybody's going to need to have a look at over the little while as we're getting close to the first deadline for that.
When is that deadline?
End of the year.
End of 2025 is when those will need to be formed for public consumption.
That's right. Yep.
All right. Now tell us about the short form restructuring reporting as part of your tax transparency rules.
So this one's another one that I think sometimes gets a little bit missed because it's got a deceptive title. So the short form restructure reporting rules are slotted into our country-by-country reporting rules. So they'll apply to a country-by-country reporting entity. But fundamentally, what is being required is similar to a DAX 6 requirement. So you will have a series of indicia. So there's a set of deemed indicia, and then there's a set of criteria for what is an otherwise significant restructure. And if either of those events takes place in a year in connection with an Australian taxpayer, that Australian taxpayer has an obligation to fill out the short form restructure report.
So inbound or outbound clients to Australia. So
that's right.
A subsidiary of Australia is involved, then could trigger those. Okay.
Yeah. And so being on the tax desk, the question I get asked the most often is, does Australia have indirect transfer rules? And the answer to that is yes, but an indirect transfer is a perfect example of something that's going to be captured within these short form restructure rules. And so one of the complexities with them is that the schema and the level of detail required is quite comprehensive. So it will go back and cover who was involved in a scheme, what the commercial purpose was, what the foreign tax benefits were. So quite a lot of detail is going to need to be provided. They also have what I call a partially retrospective application. So for 2023 and 2024 calendar year, you actually need to report on those transactions by the end of 2025. And so that's why I say this is kind of a non-TP thing masquerading as a TP thing, because it sounds like it's part of your transfer pricing report, but actually if you think about the lift required for some clients,
it's totally different
that's
data.
A lot of work.
Yeah, it's totally different data. Totally, I mean, it's more factual to understand exactly what has moved, whether Australia was involved. And again, I see a lot of these issues come up around the globe when there are these type of compliance requirements, or even like to go back to the debt point, where companies do a large acquisition and then they're moving stuff around, or the business folks and the legal folks are trying to move stuff around with no tax planning or tax reduction incentive. It's just, hey, they're trying to get these businesses and tangible assets, intellectual property, whatever the case may be, working together. Again, doesn't have to have a bad tax motive, but there's still the potential compliance requirements that are due.
Exactly. And one of the tricky bits with that is if Australia is a very, very small part of a very big picture, people in Australia might not even know it's happened. And so that's
point.
You know, it's August now, and there's plenty of time till the end of the year, but it's something that we're trying to encourage people to think about well ahead of the end of the year.
All right, maybe the last piece, because you mentioned, and I failed to ask about it, but you mentioned indirect taxes. What are those indirect taxes in Australia? How do those apply if non-Australian taxpayers moving shares of an Australian entity, for example?
Great question. My favourite question. So we've got a non-resident capital gains tax that applies where the transferred shares are in a company that's basically land rich. And so for us, land rich at the moment is fundamentally real property interests, but there is legislation that is likely to come through in the near future to extend the concept of land rich, probably to also include assets that have a close economic connection to land. So the particular types of things that are being focused on there are infrastructure assets, wind, solar. So that's a bit of a watch this space. And then the other thing we have in Australia, which is everybody's least favourite tax, is called stamp duty, which is a state-based tax. So it varies state to state, is typically imposed on transfers where you have a landholder company, but the threshold to be a landholder is quite low, and in some cases it's zero. So it's always one of those things that sort of creeps up at the last minute, but really does cause some trouble if not thought about in due course.
All right. Well, a lot of pieces there of the Aussie tax system. So let's move on now to this Pepsi case, which has gotten a lot of press at least in the international tax community. And I'll be honest, I'm just excited to talk about something other than Pillar 2 as well, Sarah. So maybe tell us, give us a little bit of the background. It was the High Court of Australia that recently came up with this case, but maybe just provide us a little bit of context and factual background of the case, and we can get into a couple of the legal points.
Sounds good. So at its heart, the Pepsi case was a case around a payment that was made from an Australian bottling company that was an unrelated third party to a Pepsi Australian subsidiary. So yes, the payment was subject to a question around royalty withholding tax and diverted profits tax, and yes, it was between two Australian unrelated parties, but that's fundamentally where we started. The broader context of the payment was that it came about as a result of arrangements between the bottling company and Pepsi US, and those arrangements were for a broader suite of marketing distribution commitments between the two parties as to how Pepsi and related products would be bottled, manufactured and sold in Australia. So as part of those arrangements, there was an exclusive bottling agreement in place between Pepsi and the bottling company. And one of the things that happened under that exclusive bottling agreement is that the Australian Pepsi entity was nominated as the seller of concentrate to the bottling company. There was a price indicated for the sale of concentrate, and there were invoices between the bottling company and Pepsi Australia for that. The debate that went all the way to the High Court was really around that contract and what rights and entitlements were passing between the two parties and what was actually being paid for between the bottler and Pepsi Australia. And so the arguments that the Commissioner put forward, so first of all, the Commissioner argued that there was effectively an embedded royalty in that payment because it was so fundamental for the bottler to perform their services that they had access to the IP, trademarks and brand of Pepsi, that it must have been the case that some element of that payment for concentrate had an element in it that was for IP.
And why is that important if it's just an Australia to Australia contract?
Great point. And the second thing that was argued was that actually what was happening under this contract is that the payment was really being derived by Pepsi US. And so what the Commissioner argued is that because of the way that the contracts worked, and it was very, very particular to the contracts, effectively by directing that the bottling company and Pepsi Australia entered into the concentrate payment arrangements, Pepsi US was entering into a payment direction for amounts that were otherwise due to it. So in effect, you've got number one, a royalty passing between the bottling company and Pepsi Australia, but number two, you've got an argument that actually that royalty was being derived by Pepsi US. And then in the alternative, what the Commissioner argued was, okay, if there's no royalty withholding tax that's applicable to this, we think there are ways that this transaction could have been done that would not have given rise to the same tax outcomes, that would have given rise to royalty withholding tax, and therefore we think that the diverted profits tax is enlivened. So if you like, the DPT was kind of the alternative. The main game was really the royalty withholding tax.
Yeah, so the price paid for the beverage concentrate, I think it was an affiliate of Pepsi US, so Pepsi Singapore, but it doesn't really matter, right? Like the issue is that the Australian tax authorities' position was, well, that payment when it left Australia to Singapore or the US, wherever, should have been a portion of which could or should be treated as a royalty, which would then potentially be subject to withholding tax and potentially subject to this diverted profits tax.
Yeah, effectively what they were looking at was the payment from the bottler and saying, well, really this payment went all the way to the US. The US was directing what happened with it. And
despite this chain of going through Pepsi Australia, Pepsi Singapore, ultimately Pepsi US.
Exactly. And so when you sort of think about that, it's a very substance-based argument. So it's very much talking about what's actually happening, what rights and obligations are moving between the parties. And really, I think the core of this case is about how far do you dig into the contract and how do you approach the contract? Do you look at it from the inside out, start with the payment and then work outwards to see what's going on? Or do you start on the outside and look at the substance and then work inwards to interpret the contract? And that was somewhat the debate that was coming through all the levels of the court in Pepsi.
And so what did the High Court of Australia ultimately hold? Maybe we start with the royalty withholding taxes, then we can talk about the DPT.
Sure. So I might take one step back and
Please.
just talk quickly about the federal court and the full federal court, because it's important to the balance of what happened with Pepsi. So at the federal court level, the Commissioner won on all counts. So it was found that there was an embedded royalty and that in the alternative, the DPT would have applied. Then at full federal court level, and that was a single judge, so we've got one judge saying there's an embedded royalty. We get to the full federal court level and it's a 2-1 majority in favour of the taxpayer. So you've got 2 judges saying that there was no embedded royalty and no diverted profits tax, and you had 1 dissenting judge. So effectively at that point we're 2-2. Then we get to the High Court and we've got a 7-court full bench, and we had a split decision. So we had 4 judges decide that there was no royalty and no DPT, and we had a 3-judge minority that found that there was a royalty and that DPT would have applied. But most importantly, all 7 judges found for the taxpayer on the derivation point. So they said, regardless of whether or not there was a royalty, we don't think under the terms of the contract that it was actually derived by Pepsi US.
I see.
So if you like, even though it was a split decision on royalties, it was a full win for the taxpayer on that point.
All right. What about DPT?
So DPT, it was 4-3 in favour of the taxpayer on that. And really with the DPT, a lot of the focus of the court was around the very bespoke nature of Pepsi's arrangements, the fact that they'd been in place for a number of years, the fact that it was really not clear whether there would have been an alternative way for Pepsi to have entered into that. And there's some deep history around, the beverage industry and bottling arrangements, and there's Harvard Business Review articles and case studies and books on it. So there was a lot of rich history in that informed the DPT decision, and it was quite a unique decision as well, because it was basically it's kind of unusual to say there was no other way that this transaction could have been done, but that's fundamentally where the High Court landed.
So what does this mean for taxpayers? I mean, maybe both in the industry, and what about other sectors? I mean, what are some of the, maybe as we get ready to conclude here, what are some of the key takeaways for taxpayers and practitioners as we see this taxpayer-friendly case that came out?
Yeah, so for me, it comes back to this contract point. So the majority in Pepsi decided that when you looked at the payment for concentrate, you started with that payment and you said, what is the consideration for? It's for concentrate. It was an arm's length amount. It was paid between unrelated parties, and they were able to separate that out from all the other rights and obligations under the contract, and say, well, even though there are commitments to provide IP and other rights and entitlements to the bottling company, those are in exchange for a lot of commitments that the bottling company is making back to Pepsi, which are to market and distribute and promote the brand in Australia. So I think that for me, the fundamental point is you start very much at the payment and then you work your way out from there. And even in the minority decision, what they actually decided is they said, when we look at the contract as a whole, we can't separate out that payment from everything else. We think it's all intertwined. Mm-hmm. And so we think there must be something in there that's a royalty, because we don't think you can, I think they said, we don't think you can subdivide the indivisible. Mm-hmm. So even when they were doing that, they were very much focused on the contract. And I think in terms of taxpayers looking in kind of other areas, and software distribution is a very topical one at the moment, I think what's going to be very important is that when we transplant these concepts into that, contract is going to be absolutely king. And yes, the economic substance will be important and we'll always sit around that. But I think we've got a clear direction here to start with the contract and work your way out, not to start with the arrangements and work your way back into what the contract's saying.
Well, I think that's great advice, a good way to end things, and that's really what I take away from this case. It's fascinating based on the facts, but as we think about the software technology companies and trying to apply these principles, certainly something that taxpayers, advisors should take note of. So, thank you very much for coming on, Sarah. A lot going on in Australia, and we'll keep an eye on things, and as those developments occur, I look forward to having you back.
Thanks very much, Doug.
All right, so thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Sarah Hickey, PwC Australian Tax Desk Leader in New York City. I'm Doug McConey, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.